There is a silent structural shift occurring right now within the core architecture of Ethereum that poses a significant threat to the decentralized nature of the network. Most retail investors are distracted by daily price fluctuations and meme coin cycles, completely missing the technical war being waged over the block gas limit. If you hold Ethereum or any tokens within its ecosystem, you are currently sitting on an asset that is attempting to radically alter its economic throughput in a way that could price out the average validator. The reality is that the push towards the Glamsterdam upgrade and the race to a 100 million gas limit is not just a software patch, but a fundamental alteration of the settlement layer. Over the next few minutes, I am going to present evidence regarding the trade-offs of this massive scaling attempt, including data on state growth, node synchronization times, and the potential impact on the fee market. We need to begin by understanding exactly what is happening behind the scenes with the developers and the large stakeholders in the Ethereum ecosystem. For years, the gas limit has acted as a throttle on the network to ensure that computers around the world can keep up with the blockchain. Currently, that limit sits comfortably around 30 million gas per block, a standard that has maintained a delicate balance between speed and decentralization. However, a new faction of developers and large institutional entities is pushing aggressively to more than triple this limit to 100 million gas. This initiative, often discussed in the context of the Glamsterdam DevNet and upcoming upgrades like Pectra, is a direct response to the competitive pressure from high-throughput chains like Solana. Let us get into the weeds of why this specific number matters and what the data is telling us about the risks involved. When you increase the gas limit, you are effectively allowing more data and more computation to be stuffed into every single block. On the surface, this sounds fantastic because it lowers transaction fees and increases the number of transactions per second. However, the hidden cost here is something called state growth, which is the accumulation of data that every node must store and access. According to recent stress tests on similar parameters, increasing the limit to 100 million could accelerate the growth of the Ethereum state size by over 400% annually. This is a critical metric because as the state size balloons, the hardware requirements to run a node skyrocket. We are looking at a scenario where consumer-grade hardware, which is the backbone of a decentralized network, becomes completely obsolete. The 30-day moving average for node synchronization times is already creeping up, indicating that the network is becoming heavier. If we force this upgrade through without proper optimization, we risk centralizing the network into data centers run by only the largest professional staking providers. This matters because the value proposition of Ethereum rests entirely on its censorship resistance and its decentralized security model. If the network becomes too heavy for the average user to verify, it begins to resemble a centralized cloud database rather than a global settlement layer. The proponents of the Glamsterdam upgrade argue that this is necessary to support the massive demand from Layer 2 rollups. These rollups need cheap data availability to function, and they are consuming an ever-increasing portion of the block space. In fact, recent on-chain analysis shows that Layer 2 activity now accounts for a significant double-digit percentage of all gas used on the main execution layer. This creates a conflict of interest between maintaining the integrity of the base layer and servicing the needs of these scaling solutions. If this deep dive into the technical economics of the market is providing you with clarity, consider subscribing to stay aligned with our institutional-grade analysis. Now, we must look at the historical context to understand the severity of this shift. We can draw a parallel to the block size wars that occurred in Bitcoin roughly 7 years ago. During that time, there was a similar push to increase throughput at the expense of node decentralization. Bitcoin chose to keep blocks small to preserve the ability for anyone to run a node, forcing scaling to move to layers above it. Ethereum is currently attempting to do both. It wants to scale the base layer aggressively while also building out a complex ecosystem of layer 2s. The danger here is that by racing to 100 million gas, Ethereum risks fracturing its consensus layer. Simulated data from recent testnets suggests that at 100 million gas, the rate of missed blocks and uncle blocks could increase significantly. A missed block occurs when a validator cannot process the data fast enough to propagate it to the rest of the network in time. If the block propagation time exceeds specific thresholds, the network becomes unstable and consensus begins to degrade. This is not theoretical. We have seen similar issues on other high-throughput chains when they experience peak congestion. Furthermore, we have to talk about the economic implications for the supply of Ethereum itself. The burn mechanism introduced in previous upgrades relies on a functioning fee market where demand exceeds supply. If we suddenly triple the supply of block space, the base fee could crash to near zero levels for an extended period. While low fees are good for users, they are catastrophic for the deflationary thesis of Ethereum. If the base fee drops too low, the amount of Ethereum being burned will fall below the issuance rate paid to stakers. This would cause Ethereum to become inflationary again, reversing the economic narrative that has driven much of the institutional investment over the last 2 years. We are already seeing signs of this in the current low volatility environment, where burn rates have hit multi-month lows. A sudden expansion to 100 million gas would exacerbate this trend, potentially flooding the market with new supply just as demand is stabilizing. The reality is that the market has not priced in the risk of an inflationary turn for the asset. Institutional models are largely built on the assumption that supply will continue to contract or remain stable. If the Glamsterdam parameters are adopted without sufficient demand to fill that new block space, the economics break down. This brings us to the concept of induced demand, which suggests that more capacity will simply encourage more usage. While this is true in traffic engineering, in blockchain markets, there is a lag time between capacity upgrades and application adoption. During that lag time, the security budget of the network is vulnerable. The validators who secure the network are paid in fees and issuance, and if fees vanish, their incentive to operate high-end hardware diminishes. This creates a dangerous feedback loop where higher hardware costs meet lower revenue, forcing the small players to shut down. We are seeing early indicators of validator capitulation in the long tail of the market, specifically among home stakers. If this trend accelerates due to the hardware demands of a 100 million gas limit, the Nakamoto Coefficient of Ethereum will drop. The Nakamoto Coefficient is a measure of how many entities need to collude to compromise the network. A lower coefficient means a less secure network, which ultimately justifies a lower valuation multiple for the asset. This is why the race to 100 million gas is the single most important fundamental variable to watch right now. It is a high-stakes gamble that the developers are taking to fend off competition, but they are gambling with the decentralization of the protocol. If you appreciate this level of unfiltered risk assessment and want to navigate these structural changes alongside us, make sure to join our community by subscribing. Let us turn our attention to the specific technical hurdles that must be cleared before this can become reality. The client software that nodes run needs to be optimized significantly to handle this load. Current benchmarks show that the execution clients struggle to process 100 million gas blocks within the 12-second slot time. If a client takes 2 seconds to process a block, that leaves only 10 seconds for propagation across the globe. As we push the processing time up to 4 or 5 seconds, the window for propagation closes, leading to centralization in geographic clusters. We could see a future where all Ethereum nodes must be located in specific data centers in Virginia or Frankfurt just to maintain sync. This geographic centralization is a massive geopolitical risk that is rarely discussed in the public forums. Moreover, the storage input and output operations per second required for this throughput are immense. We are talking about needing enterprise-grade, solid-state drives that wear out much faster than standard consumer hardware. The operational expenditure for running a node will increase, shifting the profit margins into the red for anyone not running thousands of validators. The developers are aware of these risks, which is why there is significant pushback from certain core teams. There is a fracture forming between the researchers who prioritize long-term health and the business development side that wants immediate scaling. This internal conflict creates uncertainty in the roadmap, which is something markets despise. We saw how roadmap uncertainty affected prices during the transition to proof of stake, and we are likely to see it again here. The pump the gas movement is gaining traction, but it is meeting the immovable object of physics and bandwidth constraints. So, what is the play for the intelligent investor who is watching this unfold? You must monitor the average block gas usage and the propagation times on the network. If you see propagation times spiking, it is a leading indicator that the network is struggling under the load. You also need to watch the issuance rate of Ethereum closely. If the supply turns net inflationary for consecutive months, the scarcity premium of the asset will erode. The narrative of ultrasound money is effectively under siege by the need for scale. It is a classic dilemma. Do you optimize for being a global computer or for being a store of value? Ethereum is trying to be both, and the strain is becoming visible in the technical metrics. The race to 100 million gas is not guaranteed to succeed without breaking something along the way. We might see a compromise at 40 or 50 million gas, but even that requires significant upgrades. The Glamsterdam context serves as a testing ground, but the real battle will be fought when these proposals hit the mainnet governance discussions. Expect volatility in the governance tokens of major staking protocols as they position themselves for this new regime. The liquid staking derivatives will likely benefit as solo staking becomes harder, further centralizing the stake. This is a consolidation phase for the infrastructure of the crypto market. To summarize the playbook, you need to be cautious about the deflationary narrative in the short term. Recognize that the fundamental cost of securing the Ethereum network is about to change. Do not blindly assume that upgrades are always bullish. They carry execution risk and economic side effects. Watch the burn rate, watch the node count, and watch the centralization metrics. The race to 100 million gas is the defining story of this cycle for Ethereum, and it will determine if it remains a decentralized protocol or becomes a fintech platform. The reality is that the market will punish any misstep in this transition severely. Stay vigilant, rely on the data, and do not get swept up in the marketing hype of infinite scalability. Please remember that I am a market strategist and analyst, not a financial advisor. Everything discussed here is for educational and informational purposes only and should not be taken as financial advice. You must always conduct your own due diligence and consult with a certified financial professional before making any investment decisions. The markets are volatile and the technology is experimental.